Hey everybody, in 2004, two bankers, Rana Kapoor and Ashok Kapoor, started Yes Bank. They took the company public in 2005, and since then, the bank's performance was so good that its investors were rewarded handsomely as share price increased by 14 times in 2015. That's the return of 30% CAGR for 10 straight years. But 3 years later, in 2018, its share price started collapsing. And within the span of just 2 years, it lost more than 90% of its value. The question is, what the hell happened to Yes Bank? In this video, we will look at how Yes Bank rose to the top of Indian banking industry and the reasons behind its sudden fall. Let's first understand the general business model of a bank. Bank has three crucial things to do. First, it has to raise capital cheaply and reliably. Second, it has to lend that capital to borrowers at higher rates while ensuring that the borrowers will be able to pay it back. And third, doing the first two things while maintaining enough liquidity to survive during down cycle. Now coming to the Yes Bank, the total outstanding advance, which is the amount of money the bank has lent, increased from 760 crores in 2005 to 75,500 crores in 2015. The total asset base of bank increased from 1,200 crores in 2005 to 1,36,000 crores in 2015. That's a massive growth of 26% per annum on a compounded basis. The question is, how did Yes Bank achieve this growth? Well, bank achieved this growth by positioning itself as a niche player and focusing on high growth sectors like food and agriculture, infrastructure, logistics, engineering and healthcare. They were trying to be a specialist lender rather than a commodity bank. But the growth is not the sole criteria to measure the performance of any company. What also matters is the quality of that growth. One of the key metrics which measures the quality is return on assets. This ratio shows how much of income is being generated from the total asset base. The higher is the return on asset, higher is the quality of assets. Return on asset for Yes Bank was in the range of 1.3% to 1.5% during 2011 to 2015, while the average figure for the overall Indian banking industry was in the range of 0.7% to 1%. Another key metrics which is used to measure the quality is NPA, non-performing assets. As the name suggests, this ratio shows how much of asset is not producing income for the bank. It happens when the borrowers are not able to pay principal and interest on its loan. So the lower is the NPA, higher is the quality of assets. NPA for the Yes Bank was in the range of 0.2% to 0.8% during 2011 to 2015, while the average figure for Indian banking industry ranged from 3% to 5%. So the above figure confirms that the Yes Bank was able to find opportunities to lend and increase its loan book. Also, the quality of these loans were very good. But this is just one part of the equation. Another part of the equation is to look at the cost and reliability of capital which the bank has to raise for lending. CASA deposits, which is the current account, and savings account deposits are usually cheaper and stable. Term deposits and wholesale borrowings are expensive and less stable. So let's look at the sources of funding for Yes Bank. In 2005, wholesale borrowings were roughly 30% of total assets and the CASA deposits were around 50% of total assets. In 2015, wholesale borrowings were just 20% of total assets and CASA deposits were 67% of total assets. So what we can see is the CASA deposits increased from 50% in 2005 to 67% in 2015. This means as the bank grew, it was able to get money at lower cost. So by combining both the parts of the equation, we can conclude that Yes Bank was able to gather money at low cost and at the same time lend it at higher rates while following conservative practices. Due to this, the net profit increased from near zero in 2005 to above 2000 crores in 2015, and thus there was a massive growth in the share price. But let's wear our skeptical lens to look at the growth rates. While Yes Bank was growing at 25% to 30% every year, the overall banking industry was growing at just 6% to 10% every year. Yes Bank's loan growth was way higher than the sectoral trend. The question is, was this growth genuine or something else was going on? Turns out there was something hidden beneath this growth. To understand it, let's divide it into three parts. The first point. In July 2015, UBS, which is a global brokerage house, came up with a report that Yes Bank had a significant exposure to stressed companies. Stressed companies are those companies which are facing financial difficulties such as high debt and liquidity issues, which can lead to insolvency and bankruptcy. Reports claimed that loans to such stressed companies were in upwards of 125% of Yes Bank's total net worth. This means a big chunk of Yes Bank's loan book was exposed to risky borrowers. Second point, when RBI did the detailed analysis of banks' asset quality, they found out that Yes Bank's true bad loans were way higher than what management had been reporting in their annual reports. In FY16, Yes Bank reported a gross NPA of 750 crores, but RBI said that actual gross NPA were over 5,000 crores. Therefore, true NPA ratio would have been more like 3 to 4% rather than the less than 1% as reported. And the third point, there were multiple cases of red flags which were pointing to governance issues. The board of directors of the bank were weak and were being manipulated by the MD of Yes Bank. This led to weak oversight, risky lending and financial misreporting. So 2005 to 2015 may look like a dream run because true asset quality was not visible in reported numbers. As the above thing started coming into the picture, market began to realize the problem. Market began to reprice the bank as risky lender. Market was perceiving the bank as risky because if the stressed companies begin to default, it can put a question mark on the survival of Yes Bank itself. And that's what happened during the year 2018. Many large corporate borrowers like IL&FS, DHFL, Reliance ADAG Group and SL Group either went bankrupt or went into a serious trouble. This led to Yes Bank turn large portion of its asset into NPA and requiring big provision into its income statement, which in turn led to huge losses. At the same time, because of loss of credibility, Yes Bank struggled to raise fresh capital to cover these losses. During FY20, Yes Bank reported over 20,000 crores of losses while it had a balance sheet of 21,700 crores of total equity base. This loss wiped out the equity base of bank almost completely. The result, share price collapsed by more than 90%. And that is how Yes Bank went from youngest, fastest growing private bank to to standing on the edge of failure within just 15 years. Now, here are the 3 key takeaways from this case study. Number 1, banks are highly leveraged companies, so even a small probability event can destroy the whole capital base. So it's important to think in terms of risk of ruin and not just in terms of expected return. Number 2, corporate governance risk is a real financial risk. Yes Bank didn't blow up only because borrowers defaulted. It blew up because the governance was weak and recognition of bad loans were delayed. In highly leveraged companies like banks, bad governance can erase equity capital very fast. So for banks, treat corporate governance as direct variable. And number 3, be skeptical about a very high growth rate. For Yes Bank, it looked like it was growing at a very high rate, but a big part of that growth came from aggressive lending and false reporting. So whenever you see a company growing at a very high rate compared to its peers, ask what risk is this company taking that others are not. So these are the real lessons we can take from this case study. If these 3 lessons make sense to you, pick a bank and do a company research on it. That was it for today's video. If this video provided some value to you, please like this video and subscribe to this channel for more such investment case studies. Thank you so much for watching. I will see you in the next video.